A warm welcome to Econoday Unplugged on Tuesday, the 25th of May, 2021. Mark Pender's stateside, and I'm Jeremy Hawkins in London. Away from the world of cryptocurrencies, it's been a quieter time for financial markets since our last podcast, with the Fed still insisting that higher inflation will be only temporary. Bond yields and the dollar have drifted lower, the latter now at its weakest level in around 4 months, all of which will come as relief to the emerging markets, and most other major central banks that also toe that transitory inflation line. However, for the ECB, a rising euro, and by recent standards anyway, still the highest sovereign yields in the Eurozone, imply an unwanted tightening of policy that will not sit well with the likes of President Christine Lagarde, who just last week was emphasising the need to keep monetary policy very loose. In any event, actual inflation developments remain key, and on Friday we'll get an update on the Fed's preferred measure in the April personal income and spending report. So Mark, short while ago we had some surprisingly steep rises reported in US house prices. Do you think there's upside risk to the PCE deflator too?
Well, it's an interesting question. The consensus right now, the Econodays consensus overall for the PCE price index is a shockingly high 0.6% monthly increase that would follow a 0.5%
When was the last time we saw something that high? Sorry to interrupt. When was the last time we saw anything remotely like that?
That's a good question.
They
are. I can't say, but these are very, very near record paces. Let me just check here my Econoday calendar. I can tell you. Okay. Well, the 12-month gauge, the last 12-month gauge overall was 2.3% in April. And that was, you have to go back only 3 years for that. But the core index was at a 12-year high. And so at least the monthly gain, which was a 0.3. Okay, so, it doesn't take a lot to get, the core rate came in at 0.4%, and that was the highest that we have seen. That was in April, and that was the highest since October 2009. That's a very high reading for the core. But what's interesting about this, if you look back at last month, the Econodays, the PCE numbers are pretty well telegraphed by the Consumer Price Index, which comes out a week or two before, a couple weeks before. And it didn't help Econodays forecasters when it came to March. They underestimated the 0.5% March gain by a tenth, and they underestimated the monthly gain also by a tenth. And I'm really concentrating here on the monthly because the Eurozone are so skewed by the first lockdown. But when you compare it to last month, that comparison isn't skewed. So it makes you wonder if there isn't room here for another upside surprise, even though, it's hard to believe. I have to just double check here, but the consensus is a 0.6% monthly gain overall and a 0.7% monthly gain for the core. So these are going to be, if they're not records, they're going to be at or near records.
Right. And
they're going to drive, for what it's worth, the year-on-year rates over 3%, 3% and over. So what does this, mean for policy is policymakers have taken a kind of a pass on ongoing inflation readings, saying that these are temporary one-time effects. And let's just talk about the monthly, not the year ago. So the monthly is going to be inflated by, emergency stimulus that continues to flood in, especially in the federal side, into the U.S. economy. And then you have just the reopening itself, service providers coming back, more animal spirits, I guess, and more activity. So they're going to wait, I think, a few months. So this is a definite pass, no matter how extreme. They'll downplay it, and they can probably take at least maybe 2 or 3 more reports, and will continue to downplay that. Yet inflation expectations for the year ahead are going up at the consumer level and at the business level. So as patient as the Federal Reserve may be, whether or not businesses and consumers have that same kind of, prudent or sober attitude remains to be seen. We had the consumer confidence report this morning, and it has its own inflation measure, which jumped, and we've been seeing inflation expectations readings, like I've been saying, climbing all across to record highs, multi-year highs. So whether or not the Federal Reserve has a longer, better view of inflation than businesses and consumers, we'll have to see. But if those expectations keep climbing, that's something that they won't be able to downplay. But it should make for interesting reading on Friday. Just this morning, real quick, we had the consumer confidence report, which didn't meet expectations, which is still sizably, significantly below where it was before the pandemic hit, which is kind of interesting because we have the U.S. economy is reopening, and it's not giving a significant lift to consumer confidence, which is not what the forecasters were expecting.
So do you think that's one reason why the Fed's not overly concerned about what's going on in terms of prices at the moment?
It could be. That could definitely be a factor. And I think that prices themselves, because they are going up, is holding back consumer confidence or consumer expectations. Certainly we saw in this morning's report from the conference board declines in expectations for year ahead income. So fewer see more. Their income rising, and more see their income falling. And at the same time, confidence in the stock market, though it's still the bears still outnumber are still outnumbered by the bulls, that is narrowing. So it's the consumer here isn't over, unlike manufacturers. The data that we cover, it's like manufacturers are they can't. They're sky high, all their results, and although their sentiment is a little bit less so because they're worried about shortages and being able to keep production up, and also finding workers because they're not really hiring as much. But interesting, in the consumer confidence report this morning, which is highly focused on job assessments, the assessment of the current state of the jobs market for the month of May, it was extremely strong. And so that is like a counter signal that we've been getting so many signals that, well, we had a very soft gain in April employment, and kind of is this going to go on kind of thing? And maybe it's not. Maybe based on the consumer confidence report, consumers are reporting that jobs are not hard to get and that they're super plentiful right now. So we'll see what happens, and if when that May jobs report comes out at the beginning of next month, which will be next week, a week from Friday, we'll see, and that could change everything. If that goes through the roof again, then
one would think something has to give somewhere.
Yeah.
All right. Okay. Any other big numbers we should be looking at from your side this week?
Well, we also had new home sales, and that was a kind of a seminal report right now. It showed a big slowing, and this is a very volatile report based on kind of a small sample size, and compared to the existing home sales report where there's less volatility. Well, anyway, today's report was well below expectations, and included a sharp downward revision to the prior month. And if you look at the graphs, both existing home sales and new home sales had peaked at great highs at the end of last year and have since been sliding down or easing. But what's interesting is prices have not. All the price readings, we had Case-Shiller, FHA, FA, and we also had a price reading in the new home sales report, and all those are records, near records, multi-year highs. So prices aren't being affected. To own a home, if you can afford to own a home, you're probably pretty confident because that gives you a big cushion on questions of employment and those things.
In terms of the prices, so you got the slowdown in sales, but prices are still through the roof.
Yes.
One of the issues we've seen, particularly in the UK and indeed to some extent in Europe, is that there's been, quite fundamentally, a shortage of supply. That's been particularly true in the UK. So sales numbers might well have been higher had the real estate agents had more supply actually on their books, but not having it's actually prevented sales from being as strong as they might be, simply because the homes weren't available to buy in the first place. Is there any of that happening on your side?
Yes, that is an important factor, though the decline in the sales rates have been easing that imbalance. Of course, that imbalance here is also the result of shortages of materials and labor to build a
Hmm.
home builders can only go so fast. But if you look at the home builder sentiment, the housing market index that's produced by the home builders, they are, however long, I think it's like 35 years or so, they've been putting out this indexes. They've never approached this kind of sentiment. So, they're building homes as probably as fast as they possibly can, and it's probably not fast enough.
Okay, thanks for that. Let's have a look on my side. Well, I guess it's on the whole, it's got to be said. I guess the outlook for Europe is looking increasingly favourable on the back of the accelerated vaccine rollout. Just quickly to put some some numbers in context, the share of the domestic population with at least one vaccine now for the European Union countries as a whole, it's up to 35% now. It was 32% last week, and a good deal lower than that not so long ago.
Is
So
that fully vaccinated?
well, that's just the first vaccine. Now, in some cases where there's only one vaccine necessary, it is fully vaccinated. But for most of the vaccines in Europe, you're actually going to need two. But at least that's one vaccine out of the way anyway. Germany now on that basis is up to as high as 40%. So there's been a big increase in vaccination rate in Germany, which had been one of the main problem countries as far as Europe's concerned, and why they had to extend their lockdown so many times. It's still low compared to the UK, which is running at 56%. But the big picture is that the vaccine rollout is accelerating, and that is very much being reflected in the new coronavirus cases. So I think the latest figures are putting the daily number for the European Union as a whole at about 48,000 a day. And that compares with something as high as almost 150,000 in the middle of April. So the numbers there are very much heading in the right direction.
Mm-hmm.
And that appears to be being reflected in the numbers, or at least the survey data, which have been coming in particularly strong. There'll be some more this week, which we're going to be paying close attention to. The flash Eurozone PMI for May, that was in at 56.9. That was up more than 3 points versus its final April print, well above the market consensus, and also what a best part of a 39-month high also. The only real negative, I suppose, being in this is, as you're alluding from your side, input costs are rising very quickly. Indeed, the index indicated the sharpest rise since March 2011, and output price inflation actually climbed to a new record high. Now, we haven't really seen this coming through in terms of the actual consumer price numbers yet. Indeed, the last set of figures we had for April showed core inflation dropping to just 0.7%. But again, it's in the pipeline. It's just a case of whether or not it's actually going to translate into higher final product prices, or at least consumer prices at the end of the day. Shortages, I must say, you mentioned it about supply shortages and raw material shortages. There's an interesting survey out of Germany this morning, which the EFO survey, which just in a nutshell, it was again stronger than expected, and then suggests a much brighter outlook for German manufacturing and indeed services than they thought before. There's also the construction side within this, and they found raw material shortages now running at the highest levels since 1991. So that's just after the German reunification took place, when there was a huge demand for building and so on. So it's becoming an issue now, particularly for the likes of Germany, where the goods producing and manufacturing sectors play such an important role in overall economic growth. And it may well be one reason for supposing that perhaps Germany will be one of the countries which could be underperforming due to these bottleneck supply problems as we go over the rest of the year. In terms of this week, the other, I think, surveys to keep an eye on for the EU very much will be the Economic Sentiment Index, which the EU Commission puts out on Friday.
I have a question. Okay, now I have a question about that. Now, the consumer flash. So this is why there's three main components to this economic sentiment report, but the consumer element, or the consumer component, has already been posted. And the question I have on that, and it doesn't ever seem to be revised.
It can be.
Break down a little bit what the nuts and bolts of this report.
Well, it can be, as you say. I mean, it's a bit like so many of these surveys where they go and ask the consumer sector a variety of questions about, their financial state, what they think about, the state of the world economy, what they think about domestically, and you have all these various sub indices which they put together into a nice little so-called diffusion index. Now, as you mentioned, we get a flash figure for the consumer confidence number. This is for May, which came out last week at -5.1, and then that number will be revised occasionally when we get the final overall economic sentiment report out, which includes the economic sentiment index itself, which is due out on Friday. They can be revised, but to be honest, it's very rare they're revised more than 0.1 or 0.2, something like that. So as you mentioned, it's -5.1, which is a decent number, very much heading in the right direction, and chances are it will remain that when we get the full survey out on Friday. But last time round, talk about some of the strength you've had in your numbers in particular areas. For the ESI, I mean, April itself saw the steepest rise on record and its strongest level since 2018. So we're well beyond what we saw, just before we had the downturn due to the coronavirus.
And that's the Economic Sentiment Index produced by the European Commission.
That's right, and it's a very useful index. It actually tracks GDP pretty well, and that's one reason why the ECB itself, tends to quote it in dispatches, so to speak. It's certainly one of its indices it likes, simply because it pulls together an awful lot of information into a single number. And this survey covers each individual Eurozone or EU country. Has the same questions going across all the different sectors, as you mentioned, consumer and industrial sectors, the main ones that the markets look at. But you've got other sectors in there as well, and it nets it down into this nice number. I say we had a huge increase last time round. Expectations are from the Econoday survey that we're going to see another increase, and if we do, again, you kind of think this economy really is coming back now. And the risk has got to be that we're going to see the recovery in demand taking place more quickly than supply, which ultimately must equate presumably with higher prices, I should say, at some point. On terms of the ECB, as I mentioned, Christine Lagarde, she's been busy trying to convince bond markets that there's not an inflation problem. Any increase in inflation, a la Fed, will just be temporary and due to one-off measures. And she's been supported by some of the other senior executives over the course of the last day or so. And it's got to be said, bond yields in the Eurozone have fallen, although it's probably more to do with the drop we've had of late in US yields and anything going on in Europe. And it's going to be interesting because if people remember when the ECB decided to hike its quantitative asset purchases through its pandemic emergency purchase program with a view to trying to put a cap on longer dated bond yields, it announced it'd be doing it just for the second quarter. Well, the next ECB meeting will be in early June. And kind of the speculation is that at that meeting, they'll confirm that they'll be reverting back to purchase rate that we saw prior to the big run up in yields earlier in the year. Now, yields at the moment, even though they've drifted lower, are still relatively high. And with the euro still so strong as well, it really is the case that the ECB's watching policy being tightened, even though it wants to keep it as loose as it can do. So it's going to be interesting whether or not they actually decide to come out and reduce these asset purchases, or it simply decides, well, look, we're going to have to keep them going at the current rate. Otherwise, we risk the euro going up even more and perhaps, reverse again, and the bond yields will start going back up again.
Is Brexit playing out in any identifiable way for the ECB and their policy?
Not really. I mean, they're alert to the fact that Brexit is still damaging growth in the Eurozone and in the UK as well. But if we put a straight line through the export and import sides of the balance sheets, then they're starting to move in the right direction. And obviously, it's difficult to disentangle Brexit effects from COVID and so on. But yes, it still seems that from the latest numbers we had for March, that Brexit was weighing on exports and imports from and to both the UK and the EU, but not by as much as they were in February, and certainly nothing like as much as they were when we saw some terrible numbers coming out in January. So I think for the ECB, the view is going to be, well, okay, that's one reason perhaps why we had, a disappointing first quarter GDP print. But if we put a straight line to what's going on at the moment, it shouldn't prevent growth coming back, potentially with something of a bang once we get into the second half of the year.
Are there any shortages or issues related to lack of UK imports right now for the euro?
Well, I haven't heard anything specifically in terms of UK exports going into Europe, and that's mainly because what we sell to the EU tends to be mainly in terms of finished manufactured goods. So from the input side, UK is not such an important supplier. But in terms of actually finished manufactured goods, machinery, cars, etc., yes, I mean they've certainly been hit by what's going on with Brexit.
What about financial services?
Financial service, well, of course, this is still an ongoing debate between the UK and the Eurozone, Brussels and the ECB as to what's going to happen with regards to financial services. And they're supposed to be coming out with some kind of trade agreement with regard to services within the next, month or so, I think it is now. But from the way discussions are going so far, it looks as if they're having a real problem in trying to get a concerted agreement on both sides. So, I mean, whatever happens, it seems that the UK is going to have a good deal less access to European financial markets than it had previously. But the question is just how much access it's going to get, and indeed vice versa for European or continental European banks and the likes wanting to operate in the UK.
Have there been any indications of changes in financial centers like Frankfurt or Paris or anything like that?
Yeah, there's certainly been Frankfurt, Paris, Amsterdam as well, and Dublin have certainly picked up a certain amount of business from the UK. Not so much on the FX side, but on the derivative side. But it also seems that New York in particular is trying to take a chunk of UK business as well. So London is sort of is a bit under the cosh at the moment, although it's got to be said, I think, that the original talk that we would see thousands and thousands of jobs leaving London and moving into Frankfurt or Amsterdam or Paris, that hasn't really materialized. Yes, hundreds of jobs have moved out there, but it hasn't been the big wave that people originally expected, at least so far. But of course, it's still early days because we don't know what any kind of services agreement is going to look like. Should quickly mention that the UK economy itself is doing particularly well at the moment. The numbers really are picking up. May flash the PMI there, the composite output index, that was up at a record 62. So that by UK standards, well, say by definition, it's a record, but it is extremely high. And also signs of the recovery in retail sales and consumer demand as we've got the reopening of the economy taking place as we speak. So April retail sales volumes are up 9.2% on the month. So that's a huge increase. And the good news was that within that, all of the increase was due to discretionary spending. So taking out food, drink and alcohol and the like. So it does suggest consumer demand's coming back with a bang. And indeed, total volumes, as you just say, they're up 10.5% now above where they were in February last year. So before the coronavirus struck.
Well, Econoda's consensus divergence index is just super high for the UK. Lee, I have two questions then. Why, how are the forecasters, how come they're so behind the curve and underestimating the recovery? And has the UK government or institutions or financial boards or think tanks, are they raising their estimates for the UK right now, the economic estimates?
Well, in answer to your first question, I think it's just to be fair to the forecasters, we're living in a world in which case where there are so many structural changes that the old sort of econometric models, if you like, simply don't work anymore because the monthly swings are so volatile. It's pretty hard to call a 9.2% increase in retail sales in 1 month. For the UK. If you get that one right, then fair dues. You've been a brilliant forecaster. As it is, I think the market call was about 4%. Which in normal circumstances would be exceptionally strong anyway. I think in terms of what it means for governments and the like, well, we know the Bank of England has certainly become increasingly more optimistic about how the UK economy is going to perform. Although, harking back to what we said before with all these other central banks, they still maintain that stronger growth may push inflation up, but it's still going to be temporary, and they expect under existing policy that we're going to see inflation meeting its target, 2% target, over the medium term. But it's interesting, look at, wherever you tend to look, and we had some public sector finance numbers out this morning, which may not be one of the figures that markets tend to look at particularly, at least not at the moment, because they're so far through the roof due to COVID rescue plans, whatever, that it's hard to really work out what they stand for. But the key thing, ignoring the April number, which is actually a little bit lower than expected, the financial year borrowing, so public sector net borrowing for 2020-21 financial year, is a record 300 billion, which, okay, is huge, over 14% of GDP. But that was still 90 billion less than the official forecasters, the OBRs they call them, were forecasting as late as last November. So again, it's a further illustration of the fact that, well, the economy has actually performed much better, which meant the government, if anything, has spent less than expected, and tax returns have actually been higher than expected. So although there's an awful lot of red ink out there, it's simply not as bad as it might have been, because it seems that the UK economy is actually, in the main, outperformed. And as you mentioned from the ECDI at the moment, that outperformance has been gaining momentum. And I guess it's simply because as you open up the economy, it's really hard to say, are people going to go out there and spend willy-nilly, or are they going to still be cautious because we still have the employment support schemes, which aren't due to be lifted until the end of September time. So there's still just so many uncertainties, I think. It's easy kind of to say that, well, look, the economy must be better in the second half of the year if COVID doesn't come back. That's the easy part. But how much better? It's really hard to say. What else do we be mentioning? I guess in terms of the central banks, we'll have the Reserve Bank of New Zealand be meeting later on this evening. No change is expected there. So their official cash rate still down at just 0.25%, a record low. And certainly no change in their quantitative easing ceiling, which stands at 100 billion Kiwi dollars. Back in April time, the RBNZ, again, they expect inflation to spike in the near term and probably move above 2% target midpoint. But again, they also expect that to be only short-lived. So come into the camp of, yes, inflation's going up, but don't worry about it. And ditto, South Korea will get their policy announcement back into this week, and they expect to see no change there either. Okay. Anything else?
I think that'll do it for me.
I'll do it for you. I'm sure it'll do it for our listener as well. So let's wrap it up there then for this week. On behalf of Mark and myself, as ever, thanks for listening. We'll be back next week. And in the meantime, you can get all the key market moving data and events listed and analysed in Econoday's global economic calendar. We'll see you next time. Bye for now.